0.04%. That's what Vanguard now charges you to hold VYM, their $92 billion dividend ETF. They quietly slashed the expense ratio from 0.06%. And most people didn't even notice. But when I ran the numbers on what that 2 basis point cut actually does to $200,000 over 20 years, I found something that completely reframed how I think about the VYM versus SCHD debate. And there's a concept at the end, what I'm calling the fee floor advantage. That might change how you pick dividend ETFs forever. Let me show you exactly what I found. Quick disclaimer. I'm not a financial advisor and this isn't financial advice. Always do your own research before making any investment decisions. In February 2026, Vanguard announced fee cuts across 53 funds. This wasn't small. Nearly $600 million in combined investor savings over 2 years, their largest cost reduction ever. And VYM, the Vanguard High Dividend Yield ETF, got one of the biggest individual cuts in the batch. Most funds dropped by a single basis point. VYM dropped by 2, from 0.06% down to 0.04%. That makes it one of the cheapest dividend ETFs on the entire market right now. Now, here's what most people get wrong about this. They see $40 in savings on a $200,000 portfolio and think, who cares? And I get that reaction. In my own portfolio, I almost dismissed it too when I first saw the headline. But that's because our brains are terrible at understanding compounding. We think in straight lines. Money grows in curves, and that difference between a straight line and a curve is where the real money hides. Let me show you what I mean with Harry's money. And this is the part that genuinely surprised me. Harry puts $200,000 into VYM. Doesn't add another dollar, just lets it compound with dividends reinvested. At an average annual return of roughly 11%, which is close to VYM's historical annualized total return over the past decade. Here's what happens under 2 slightly different fee scenarios. Under the OLD expense ratio of 0.06%, after 10 years, Harry's $200,000 could potentially grow to about $564,000. Under the new ratio of 0.04%, roughly $565,800. A difference of about $1,000 after a full decade. I can hear you thinking, $1,000 over 10 years? That's barely a dinner a year. Why should I care? But stay with me, because this is where the fee decay effect kicks in. And it's the concept that changed how I think about small fee differences. After 20 years, Harry's portfolio at the old rate could reach approximately $1,595,000. At the new rate, around $1,600,800. The fee savings alone could potentially add nearly $5,800 to his account. And he changed absolutely nothing. Same ETF, same strategy, same amount of effort, which is 0. He just paid less. The compounding did the rest. And here's the part nobody talks about. That gap accelerates as the portfolio grows. When Harry's account hits $500,000, the annual savings jump to $100. At $1 million, $200 every single year, draining out of your account and into the fund company's pocket. The bigger the account gets, the more those 2 basis points either cost you or save you. This is what I call the fee decay effect. Small fees don't stay small. They compound alongside your money. And the longer your time horizon, the more destructive or beneficial every single basis point becomes. Now let's bring SCHD into this conversation, because that's the comparison everyone actually wants, and this is where it gets really interesting. SCHD still charges 0.06%, the exact fee VYM just left behind. So for the first time, VYM is actually cheaper than SCHD. Vanguard's giant just undercut Schwab's darling. And it creates a question I've been wrestling with in my own investment planning. Does VYM's new cost advantage change which fund actually wins for long-term investors? Let me break down what actually separates these two, because they are not the same ETF wearing different labels. Not even close. VYM holds 569 stocks. That's massive. Broadcom sits at the top at 6.5%, then JP Morgan Chase at 3.4%, ExxonMobil at 2.8%, Johnson & Johnson, Walmart. It tracks the FTSE High Dividend Yield Index. Essentially, every large cap company in America paying an above-average dividend yield. Financial services dominate at 22% of the fund, with meaningful exposure to technology, healthcare, and energy. It's the wide-angle lens of dividend investing. You're getting basically everything. SCHD takes a completely different approach. About 104 stocks total. Companies need 10 consecutive years of dividend payments just to qualify for inclusion. Then it screens further for financial strength, return on equity, and cash flow quality. The result is concentrated and intentional. ConocoPhillips at 5%, Chevron at 4.9%, Lockheed Martin at 4.8%, Verizon at 4.5%, Bristol-Myers Squibb at 4.1%. And here's something recent that matters. After the March 2026 reconstitution, effective March 23rd, SCHD added Abbott Laboratories, UnitedHealth Group, Procter & Gamble, Qualcomm, Accenture, and Comcast. It's shifting away from pure cyclical exposure toward more diversified, recession-resistant holdings. That's a meaningful change. Think of it this way. VYM casts the widest net possible and catches everything. SCHD uses a spear. Fewer targets, but each one is carefully chosen for quality. Now here's where the numbers tell a story that surprised even me. And I think this is the most important part of this entire breakdown. SCHD's current yield is 3.64%. VYM's is 2.35%. On $200,000 invested, that's a difference of roughly $2,580 per year in dividend income. SCHD could potentially put about $7,280 in Harry's pocket annually. VYM? About $4,700. If income is what you're optimizing for right now. If you're building a passive income stream, if you're approaching retirement, if cash flow matters to you today. That gap is enormous. It's over 50% more income from the same amount invested. But, and this is the part that changes everything, yield is only half the picture. And focusing on yield alone is one of the biggest mistakes I see dividend investors make. Over the past year, VYM has returned approximately 18.7% total. SCHD? About 18%. Nearly identical over 12 months, but zoom out further and the story shifts dramatically. Over 5 years, SCHD has delivered roughly 12% annualized total return. VYM sits closer to 11% and over 10 years. SCHD's annualized total return is approximately 14% versus VYM at around 11%. That 3 percentage point annual gap sounds modest. It is not. Run those numbers forward on Harry's $200,000 and the divergence is staggering. $200,000 in SCHD at its historical pace could potentially grow to around $621,000 after 10 years. VYM at its historical pace? Roughly $565,000. That's a potential gap of about $56,000. Already significant. But after 20 years, SCHD could theoretically reach approximately $1,929,000. VYM at around $1,600,000. A potential difference of over $329,000 on the same starting investment, with no additional contributions. Just the compounding difference between 14% and 11% annualized. So does VYM's 2 basis point fee advantage close that gap? Let's see. $5,800 in fee savings over 20 years versus a potential $329,000 total return difference. The fee cut is real and permanent. But it's a rounding error compared to the performance gap. And this is the insight I want you to walk away with. What I call the fee versus alpha trap. Investors obsess over expense ratios because fees are the one number you can control. They're certain. They're published. They're easy to compare on a screen. They feel safe to optimize. But chasing the lowest fee can blind you to the thing that matters more. Which fund is actually better at growing your wealth over time? Past performance doesn't guarantee future results, obviously, but the pattern is hard to ignore. Now, before you write off VYM entirely, let me be fair. Because VYM does something SCHD simply can't do. It gives you 569 stocks worth of diversification, nearly 6 times as many companies as SCHD. In my experience, that kind of broad coverage matters most during the ugly years. The corrections, the crashes, the sector blowups. If SCHD's concentrated bets go wrong. One bad sector rotation, one energy crash, one healthcare scare. It shows up fast in a 100-stock portfolio. VYM absorbs those shocks across hundreds more holdings. That's real risk management you can't see in a return chart. And the sector exposure is genuinely different in ways that affect portfolio construction. VYM leans financial services at 22% with meaningful tech exposure through names like Broadcom. SCHD leans energy, defense, and consumer staples. If you already own VOO or an S&P 500 index fund, VYM actually creates more sector overlap than SCHD does. Worth thinking about when you're building a complete portfolio rather than just picking one fund in isolation. So here's my decision framework. And it's simpler than most people make it. If you need income right now, SCHD's 3.64% yield could deliver over 50% more annual dividends than VYM on the exact same dollars invested. For retirement or near-retirement investors who need cash flow, that's the play. If you want the broadest possible dividend exposure at the absolute lowest cost, VYM at 0.04% is now the cheapest major dividend ETF you can buy. Full stop. For accumulation phase investors with 20 or 30 years ahead who just want to set it and forget it. That simplicity is powerful, and if you want both, nobody says you have to choose just one. A 50-50 split, 100,000 in each, could potentially give Harry the broad diversification of VYM plus the quality income engine of SCHD. Blended expense ratio, 0.05%. That's borderline free. And the combined dividend income on that split, roughly $5,990 per year, about $500 a month in potential passive income. Not bad for two funds that cost you less than $1 a day in fees combined. Here's what I actually did in my own portfolio after seeing these numbers. I stopped thinking of VYM and SCHD as competitors. They're complements. VYM gives me the broadest possible dividend base at the lowest cost. SCHD gives me the quality filter and higher yield that I want from my core income holdings. Together, they cover different sectors, different selection methodologies, and different investor needs. That's not a compromise. That's portfolio construction done right. Now here's the concept that ties everything together. The fee floor advantage. Every time a fund cuts its expense ratio, it doesn't just save you money this year, it permanently raises the floor of your compounding engine. That 2 basis point reduction isn't a one-time promotional event. It compounds every single year for as long as you hold VYM. 20 years from now, 30 years from now, that lower fee is still working silently in the background. And Vanguard's unique ownership structure, where profits flow back to fund holders as lower costs rather than to outside shareholders, means their fees historically only trend in one direction: down. SCHD is run by Schwab, also a respected low-cost leader. But Schwab hasn't matched this particular cut yet. Fee wars in the ETF industry tend to be contagious. When one giant moves, the others usually follow. So they might. But right now, today, as of March 2026, VYM holds the cost crown. Most investors chase yield. Smart investors focus on removing every possible point of friction between their money and compound growth. Vanguard just reduced that friction for everyone holding VYM. The question isn't whether 2 basis points matters. It's whether you're paying attention to the small advantages that compound into massive differences over a lifetime of long-term investing and wealth building. If you want to see exactly how SCHD's 2026 reconstitution changed its top holdings and what it means for dividend growth going forward, that breakdown is right here. And if this changed how you think about fees versus yield in your investment strategy, drop your VYM or SCHD allocation in the comments. I read every single one,